Hi friends, welcome to my channel. So this is my fourth video on fundamental analysis. So in the previous video we have covered profit and loss statement, balance sheet and cash flow statement. So today we are going to cover other financial ratio. This first is profitable ratio. So before going to all these ratio, why it is important, what are these ratios and all. So for example, if you go to school, and how will you decide how many students are above average and below average, instead of going and asking each student how much he scored in particular subject for all for six subject, and after that and another student you are asking same thing, how much he scored in all six subject. So then if you compare, it is very difficult. So instead of that, what you will do, just you will ask the percentage, how much percentage you scored, and other how much percentage you scored. Instead of each and particular subject, we'll go for the average, the percentage will ask, so what percentage you got, like that. So that will make you to take a quick decision, so how many students are above average or below average. So in the same way, here are some ratios. So so these ratio will make you to take a quick decision, is it better to invest in this particular company or not. So instead of going annual report in deep, and after that going another annual report, and after that you are comparing. So instead of if you go to these ratios, then you will come to know, so either it is company is making profit or not, like that. So here, in first, the profitable ratio. So in the profitable ratio, by name itself will not know the ratio which are related to profit and all. So here you can see EBITDA, PBIT and PAT. So what is EBITDA means earning before interest, tax and depreciation and amortization. So in PBIT means profit before the tax, and PAT means profit after the tax. These all the things we have covered in the profit and loss statement. Here you can see the profit. So Adani Enterprise, here it is. So in the profit and loss statement, here the operating profit plus other income. Okay. So so in this operating profit plus other income, we'll call it as a EBITDA. We are earning before paying any interest, tax or amortization, depreciation, like that. So this we call it as a EBITDA. And this profit before tax, this is their PBIT. And net profit we call as a PAT, like that. Okay. See here you can see some ratio, companies essential ratios are there. So market cap, I as already told you, it is the net worth of that company. If you want to buy the company, you have to pay this much amount. So how will get the number of shares into current market price? If you multiply these two, we'll get a market cap. Okay, and we have covered the face value also. And here you can see dividend yield also. I already told you, if the company is making profit, and it will give some percentage of profit to the shareholders, and that it will be included here. Okay. And after that, you can use a debt. This debt means the company, how much the loan, particular company took a loan. So this debt, it is 4,220 crore. That Adani took this much loan. Okay. And this, what is this cash? Means the company is holding this much cash in their account. Okay. And promoters, I already told you, it will get in the shareholder patterns also. And here also will get, okay, EPS also I covered, earning per shares, whatever the profit you are getting, for that, that is the overall profit. If you divided that overall profit by number of shares, we'll get a EPS, earning per share. Okay. So here we have ROE and ROC. This ROE means return on equity. So how much return you are getting? What will be the return of this company? The net profit. So the net profit per net profit divided by the equity will get a ROE. Okay. And ROC, return on capital employed. So this is also same thing. Okay. First we'll go to the ROE here. Okay. ROE means return on equity. So profit divided by the equity. So profit will get in the profit and loss statement. So here net profit is 720 divided by equity. That equity will get in the balance sheet. What is the equity? Equity means addition of this share capital plus total reserves. Okay. This 720.70 divided by 109 plus 5130, then you will get a ROE ratio. Then after that, what is this ROC? Same thing, return on capital investment. So here, when we are comparing with ROC, here we are adding debt also. Here in this, we have not added debt. This debt, whatever the debt is there, that loan we have not added while calculating the ROE. Okay, in this calculating ROC, we'll add debt also. Okay. So when we are adding debt, So we need to take a profit before paying the interest. Okay, here this much interest we are paying. So before that, whatever the profit we are getting means EBITDA. EBITDA means I already told you, operating profit plus other income. So these two will be the EBITDA. So EBITDA divided by the share capital plus what is that, other income. So sorry, share capital. In the balance sheet we'll get to know. Okay, this net profit is 720. So here that EBITDA will be operating profit plus other income. Okay, EBITDA, operating profit plus other income divided by the share capital, total reserves and borrowing. So here add this borrowing also. Okay, if you divided the above EBITDA divided by these three things, we will get a ROCE. So this is the true value, ROE and ROCE. So when to see ROE and to see ROCE means the company there is no debt, the debt is zero, then it is better to see ROE, how much profit they are making. Okay, this much percentage means if the company is investing 100 rupees and it is taking profit of 15.39% like that. Okay, so if they took a loan and they are so then how much it is making a profit. So this is the value ROCE. Okay. If it is the company, particular company is having debt, then you need to see ROC. If there is no debt, then it is better to see ROE alone. Okay. So other things we'll cover in the next videos. Okay. Thank you, friends.